Mortgage Insider. Brian here to go over the news of the day. It is a busy week, September 21st. Let's see what's happening. So, headlines, Bloomberg says it, Fed delivers a third straight rate hike, 75 basis points. Stock markets are down across the board. Even crude oil is down in the face of Putin announcing 300,000 reservists, and he's going to double down on the war in the Ukraine. So it's a multi-stack news day to day. Specifically, the Fed is what we're here to talk about. So just in the last few minutes, we've seen actually a little bit of a turnaround. The 30-year Treasury bonds are actually down. So long-term bonds even lower than the 10-year. That's a new inversion. The 10-year Treasury is actually down 1 basis point. That's the chart I have up here. Both yesterday and today, in advance of this Fed meeting, hitting the high point, the 100% Fibonacci retracement level. This dates back to 2011. That's how long it's been since the 10-year Treasury has been this high. So we're testing that level. So far, we've just barely touched it. Looks like it's trying to go back down. But the rest of the chart here shows the 1-year Treasury, 2-year Treasuries continue to climb. Those are most impacted by the short-term rate hikes of the Federal Reserve, which is what they did today. Even the 7 years higher than the 10-year. So we a lot of times focus on this 10-year, but the 10-year is really just what we track that helps us figure out what's going to happen with mortgage bonds. So let's talk about mortgage bonds today. Universal mortgage-backed securities, these are the securities traded. Investors buy these securities as their price drops. So red is bad here. As their price drops, the rate of return to that investor is higher. So we've seen just a constant battle going on. Similar with the Fibonacci retracement level here. This dates us back quite a long ways. The 5% coupon for mortgage-backed securities has not been used for a decade. That's how long rates have been low. So here we are. Yesterday, breached really close to that same level that was identified. Today started off actually improved since the Fed meeting, which is going on. The announcement just came out 25 minutes ago. Fed chairman will come out and start to speak in a few minutes. So I'll be watching the news, seeing what he has to say. He'll take questions. His comments will be market moving. I mean, the tone today from just the statement provided from the Federal Reserve is that more rate hikes to come, more substantial rate hikes to come. I think that's the key. 75 basis points. There's been a debate of whether or not they might put 100 basis points. No 100 basis points today, but if they keep doing 75 basis points, they'll get there pretty quick. Ultimately, they don't know where they're going. They don't know how high they'll raise these rates. The short-term interest rate does impact all the rates down the spectrum. And what we're seeing on, like, say, the 10-year Treasury, we see those 10-year and 30-year bonds not being as heavily impacted. That's the market telling us that these short-term moves the Federal Reserve's doing is going to have muted effect long-term. The economy is not going to, continue to climb. Inflation's not going to continue to climb over that 10-year time cycle. But short-term pain, hopefully for a long-term gain. A secure housing market, a secure economy would be great, but it might not be a soft landing getting there. Make it a great week. Reach out if you have any questions.